Hi there. Medical Property Trust, as you can see, is paying a dividend over 5% and the stock price year to date is up 10%. Now, you may make some money with this REIT or not. Everything depends when you buy and when you sell. For instance, let me show an example. If you had bought at the beginning of this year, when the price was about $3, your return would have been over 80%. A great performance. Year to date, you are above the S&P 500. But if you bought when the stock price was around $21, then your return would have been minus 74%. That's quite bad. And by the way, you also got a cut in the dividend. Because if you look at their past history, you can see that in the past, in 2021, they were paying a dividend of around $1. But then, their dividend, as you can see here in this graph, has been cut in half, from $1 to 50 cents. And as you can see, the dividend is expected to decrease more in the future. So you have to be careful when you invest in this company. That's why it's important to know the fair value. If you know the fair value, you look at the risk and the reward. What's the highest price? What's the lowest price? And when the price gets around the fair value or below it, you take advantage and invest in that company if you like it. Of course, if you like the risk. So, this video is about their opportunities, what medical property trust can deliver in the future, and the next video is about the fair value of medical property trust. By the way, the next video is only available for members. So if you want to find out the fair value of this company, then join my channel. You have a button, join, and you can see that video. Plus other videos, private videos with fair values for different companies. So let's begin. As you can see, they reported the results for the second quarter. And if you look at what they're saying, they sold more assets to survive, to increase their funding, their cash position, and reduce their debt. Because as you probably know, if you look at their balance sheet, you can see that their total assets are about 16 billion. So 16 billion. And the market cap is only 3.3 billion. So if you only look at the total assets and the market cap, you might say that if you invest right now in this company, you can make more than 4x, right? But don't rush. Look at the real assets, as you can see here, net investments in real assets, which are around 12 billion. Still not bad. A huge margin of safety if you look only on their assets. Then, besides this, their total assets, especially their net real estate assets, you also look at their debt, which is around here, net debt, 9.3 billion. So you subtract their debt from their net assets, and you are left with around 2 billion and something, almost 3 billion. So now you compare their net assets to their market cap. So as you can see, the market cap is traded above their net assets. So let's do the math. Let's take their total assets, their net assets. So you subtract from 12 billion their net assets, their debt, and you are left with 2.7 billion. So as you can see, their net assets without their debt are around 2.7 billion. And if you look at their market cap, it's traded around 3.3 billion. So as I said, the price is above their net assets. So you can rely only on their assets. If they want to liquidate the business tomorrow, this is what you get, 2.7 billion. But by the way, if they start selling all their assets, they won't get this price of 12 billion. They'll get less. You also have to be aware of that. So when you invest in a company, don't look only on their assets. It's a good indicator, but avoid it. What's important is, especially for REITs, the funds from operations. This one. This is the most important indicator. If you look at this indicator, funds from operations, and you can see, predict their future funds, and calculate the fair value, then you might want to take advantage. So if you look at their funds from operations, you can see a huge decrease in the second quarter compared to last year. Same for the last 6 months, a huge decrease. That's why it's quite important to look at the most important indicators. And this happened, as you probably know, this decline in their funds from operations because of higher interest rates. Let me show you here. But as you probably heard, the Fed has started to reduce the interest rates. As you can see, they went up to 5.3%, and now, more recently, they started to go down to 5.1%. Over the next 5 years, the rates are likely to go down. It might go to 2%, 1%, or lower. But nobody knows exactly if they will go down to 0 or only to 2%. Everything depends on the economy, inflation, and other factors. So you have to be careful. Now, as interest rates went up to 5%, as Medical Property Trust has a lot of debt, also the interest they have to pay on that debt got higher, and they reduced their funds from operations. So when a company has a lot of debt and interest rates go up, they are affected. And that's why the stock price has declined so much. From 2020 to today, a decline over 76%. And you look at the interest rates from 2020, at the end of 2020, let's look here, they were about 2.5%. And then they doubled to 5%. So you have to be careful. Of course, if interest rates go back to 1%, 1.08%, and also the stock price of Medical Property Trust may go back to $20. Of course, from the current level, will double. Then from $10 to $20, that may happen again. But of course, this is available for all companies, not only Medical Property Trust. So if you believe that interest rates will get lower and lower, then Medical Property Trust may be a good investment for you, as they're also paying a dividend about 5%, which is expected to be stable, somehow stable. It will decrease a little over the next years. But if you also look at the results, you also have to be aware that they are selling a lot of assets to pay back their debt and stay in business. As you can see, a sale of 1.1 billion, 300 million, then another selling of 160 million, and they succeeded to repay about 1.5 billion in debt. But by selling a lot of their assets. And you don't want this, because if they continue to sell their assets, guess what will happen to their funds from operations? With their rent. Their rent will get lower, right? It's logical. But if their rent gets lower, their funds from operations get lower, and also the fair value of this company will be lower, so the stock price. So that's why the revenue and funds from operations are expected to decrease over the next 5 years. So you have to be very, very careful, because if they continue to sell more assets, funds from operations will decrease, and so the fair value of this company. But as I said, everything depends how they can manage their debt. And of course, this huge debt depends a lot on interest rates. If they go down, medical property trust will do well. If they stay high for another year, let's say they will stay about 4%, something like this, then medical property trust will be affected. They have to continue to sell more assets and their funds from operations will decrease. So it depends a lot on the management and also on the interest rates. That's it for this video, and if you have other questions, let me know in the comments and see you in the next video about the fair value of this company.